All right. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker HIMX Himax Technologies. Been a little over a week since we did a stream, a little bit later than intended, going a little bit kind of off schedule for the next few months. I am primarily a student, as I've kind of mentioned before on the channel, but during the summer I am trying to fill in some summer work. And so now that I have a work schedule, I kind of have to fit streaming in around that, but whatever. We'll kind of eventually fit it into the schedule a little bit smoother, hopefully, and have it set up. Like I was saying, I'm still expecting to do at least one valuation a week. Is kind of the plan, assuming I can kind of keep that in place. The job I kind of got is relatively physical work, so it's a bit tiring, but we'll kind of see about that. Anyway, getting into the stream itself, taking a look at our watch list. There's been a little bit some changes to the watch list itself. I've kind of done some pruning, I guess you could say. I cleaned out a few older valuations that were kind of close to a year old, and so that's kind of the point where I usually kind of say that they're no longer worth keeping in here, as well as I kind of cleared out some valuations that I thought were a little bit messy. Either there were some issues with their share structurings because of them being foreign ADSs or something, or some weirdness in the correlations used for some commodity-based companies, and a few other odd things. I just kind of removed a few things that I thought were unreliable valuations, as well as some of the ones that had been up near the top of the list for the last a long while. And I didn't necessarily agree with them as far as like the risk was being portrayed, namely being like Nerdy Inc., as well as what's it called, Honanian Enterprises, one of the home builders that has like really dead it up the hill. I readjusted the valuations on those to more reflect their actual risk, which brought Nerdy down from like number 1 to number like 5 or so, which I think is a little bit more reflective of their actual risk profile. But the other one, it actually brought them way, way, way down the list, which I think is much more reflective of their risk. Anyway, so essentially I just adjusted some ways I was kind of doing some of the valuations on a few of the stocks to make the watch list now, I think, a little bit more accurate and reflective of what I think for as many of the companies as possible. But that did bring our total list now down to 72 companies in the watch list, but that is what it is. And then I'm also still working on cleaning some other factors out. I also got rid of several columns and cleaned it all up so that it all could fit on the screen here without me having to kind of slide sideways to some of this other stuff over here. That stuff has to do with my portfolio and actually making purchases. So it's not really relevant for you guys to look at, but all the stuff that's actually relevant for you guys to look at, I can actually fit on the screen a little bit more smoothly now. So there's that. Anyway, the list of companies that I had kind of trimmed out of various 13Fs and done some screening of, which we kind of have down here. The stock we're doing today came from that list, and so that is what it is. I am planning to do WSM next, Williams Sonoma. I've already kind of started on that valuation, so that's likely to be the one moving on to next. Some of these other ones are commodity companies or other weird ones, and I might get around to them, but it's not necessarily like I'm going in order. But either way, that's kind of the plan for the near future, is to do WSM after today. So we can go ahead and get into HIMX Technologies. Oh, actually, before I do get into that, if you are watching and you do like the content that I provide, it'd be really, really appreciated if you could give us a like. It really helps attract other viewers to the channel. And if you're also interested in the chat as the pinned comment, it's also in the description below is the link to our Discord channel, where we have all sorts of conversations and stuff about various things. You guys can join up and be part of the conversation a little bit. Both of those things are appreciated and available for people. So anyway, we'll get into HIMX Technologies. HIMX Technologies, I don't know a whole lot of super detailed information about the technology itself. I'm definitely not going to pretend like I do. This is very much a very kind of top-down, high-level way of thinking of their growth and potentials about that. I'm not very super knowledgeable about the specific technology, but what they do is do a lot of chip and driver applications for a variety of display technologies, both in large applications like LCD TVs and things like that, and small applications like tablets and other panel screens for automotive devices. We'll get into their little earnings deck that has a little bit more details on that later on. And don't get necessarily too caught up on the price here, though I have already put most of my assumptions in. So yeah, the valuation isn't looking too hot for the company, but we'll go through everything as we typically do. They are a Taiwanese company, so obviously that is what it is, and you can think about that however you want to think about that. Since they're not directly making semiconductors, but they take semiconductors essentially and put them into other things in sort of an intermediary process, I'm treating them as part of the semiconductor equipment grouping. That gives them an unlevered beta due to them being part of the global grouping, not the US grouping. It gives them an unlevered beta of 2.03 and an expected sales capital ratio for their industry of 1.2 and an adjusted net margin that's adjusted for R&D of 20 to 21% in the most recent year for that industry. Now, we also have their disaggregation of revenues and assets by geographies to assign their equity risk premium to them. They get 81% of their revenues from China. That's pretty substantial. 14% from their own home geography of Taiwan itself, and then 4% from the rest of Asia, and then tiny percent from everywhere else. So basically, just mostly Chinese revenues, but Asia kind of generally. And then their assets, well, most of it is in Taiwan, and then they actually do have some small amounts of assets in U.S., China, Korea, Israel, and Japan. But as you can see, basically Taiwan. So that is also what it is. Anyway, with the unlevered beta of 2.03, it's good that they have a relatively small amount of debt. We end up with a debt to equity ratio of 12% for them, because that brings their levered beta up to 2.24. And you might be like, wow, that's a really high beta. Well, hell, their market beta, actually using volatility, is 2.01 itself. So, not necessarily too far off. Though obviously ours is still a little bit higher. That brings the cost of equity up to 16.8%. And then that's against the weighted average cost of capital I have for them of 15.07, because they actually do have a really, really low interest rate, but they have basically no debt. Very, very small amount of debt. Again, 12%, not no debt, but small amount of debt. And then it's a weighted average maturity of 1 year. It's basically all short-term debt. So they're basically just rolling over relatively short-term debt. And that's kind of their whole situation. So we'll take a look at their finances over the 10-year period. You can see that the revenues have basically doubled over the 10-year period. Granted, the vast majority of that did show up in the last year. So that's something we kind of have to take into account when we're making projections about the future, even though I am going to be relatively rosy on my revenue expectations for them for the future. So either way, we're going to be pretty optimistic for them. You can see that prior to 2020, prior to COVID, they had gross margins averaging about 23 to 24%, which was still about the same for 2020, but then in this really, really large jump in 2021. So really, we are likely to assume that they would come back to a gross margin roughly in line with that, maybe a little bit higher than that, having gained a little bit more of a competitive position, but not necessarily too much higher than that. And then R&D costs, they've increased pretty significantly over the time frame, more than doubling them over the entire course of the 10-year period, and that didn't show up at the last minute, although it was a pretty large jump also in the last most recent year. But either way, they had grown that a little bit more substantially along the way, which basically means they were investing in the prospect of getting those future revenues eventually anyway. So anyway, that does turn into reported income margins for them over the period. If we look prior to 2019, they end up with a reported net margin on average of 4.5%, which is not very high. But obviously, we like to capitalize R&D, which changes the way we think about net margins. So if we look at the net margins after capitalizing R&D, it takes it to 10.2% over that same time frame. However, those last years in the past are not necessarily super reliable because of the way R&D capitalization works. So maybe we use the most recent 5 years prior to COVID, it was 6.63%. And that same comparison for the GAAP income margin would be 2.64%. So like 3 times higher is their net margin once you adjust for R&D. And if we look at the most recent 5 years, well, it's actually 10% and on the adjusted R&D level, and then the gap level was 7.36. So that gap had actually closed a little bit more in the recent years, but still significantly higher. And then it's important to kind of understand the way these margins are moving, because obviously the margin in the most recent year is 30%, which is way higher than we can reasonably assume that they can achieve. But the question is, like, what type of margins can we actually assume that they can achieve moving forward, which we'll get into in a little bit. I think thinking about their kind of averages over the last 5 years is a pretty reasonable way to think about it, even if we gave them the benefit of the most recent year in the coming years to come. So anyway, looking at their cash flows, they do pay out dividends, but it is a little bit of a lopsided, sporadic dividend. They seem more than willing to up and lower the dividend at different points, depending on how much cash flow they have. And then they were very quick to also not pay the dividend during 2019 and 2020, and then quickly pay a pretty decent dividend in 2021. And in fact, there is a relatively high special dividend expected in the very near future for people who get into the stock within the next week or two. But obviously, I think the valuation's a little rough. Hey, Nukit, what's up? Welcome to the stream. So anyway, if we do take a look over, say, the most recent 5 years, on average, they had $68 million to pay out to their shareholders, and then the amount that they actually did pay out to them on average was $20 million. So definitely not overpaying the shareholders in the recent 5 years. If we look over the longer term 10-year period, it's an average of $59 million to their shareholders that they have, and they paid out 27. So maybe about half of their cash flow in general that they have available to pay out to shareholders is what they do in the more recent period. Yeah, that's right. I did actually put it in here. The special dividend that's expected to be X dividend within, I think it's like within a week or two, is $1.25 per share. So there's a 13% special dividend that people can pick up essentially in the very near future on this stock. Granted, that will be subtracted from the price, so don't think you're getting something for nothing. But there is that to be noted. Although again, the valuation is a little hot. So it would only be a special note if the stock was actually undervalued. But whatever. I digress. So taking a look at their returns on invested capital, we see the returns on invested capital they had on average over the period prior to COVID was about 13%. And then comparing that with it, including COVID, it's a little bit higher, 15%, which is not too much of a difference. So I think that's a good way of kind of taking out the difference. We were seeing a huge difference in their net margins based off the most recent year versus kind of prior to COVID and the more special dynamics that existed in the market in the last year. So you can see that as far as on the capital base goes, that kind of straightens itself out pretty well. So anyway, getting into their balance sheet, I don't necessarily have a lot of comments to say about the balance sheet other than that, pretty strong growth in assets and very strong growth in the current assets as well, while also growing the current liabilities, but they have a really large gap between the two, so there's not necessarily a huge problem there. In fact, the total liabilities they have is less than their total current assets. So, and in a certain sense, they're extraordinarily cheap on a book value kind of basis when it comes to like looking at that. If you think about it in almost a net kind of sense, you almost get like the operating assets essentially for free. But obviously, like I said, the stock price for even the current assets is a little pricey, and that concept generally assumes that maybe you could liquidate the current assets yourself. But I mean, looking at the multiples, you can kind of see they are currently trading at 3 to 4 PE, or 3.5 if you adjust for the R&D, relative to any level of their more recent past. Looking before COVID, on average, we were seeing 30. And if you include those years, it's 27, maybe the most recent 5 years, 26. So, I mean, yeah, their PE has been all over the place, and that's because I'm kind of including some negative numbers in there, which are generally meaningless. So even if we discounted that one, as well as perhaps, I didn't already include it, but, no matter how you look at it, they were trading at pretty nice, rosy PEs throughout the last 10 years in general. So seeing them trading at 3 to 4 now is pretty interesting. It's just a huge divergence from that past, though there were occasional points where it was still trading relatively cheap. You can see back 10 years ago, it was trading at least kind of in the ballpark, but still twice as high. Anyway, so we can kind of get into looking at thinking about the future. As I had kind of already said, the valuation is not looking super hot. Which I don't know, it's possible that there's a mistake that's being made in somewhere in here, but I'll kind of cover that in a second. We will take a look at their earnings deck first before I get into my revenue model, covering a few other little things. I was going to say, like I said, they do a lot of applications as far as their display drivers in a variety of products, both in like screens for like televisions, but also automotive applications, lots of Internet of Things devices. I did find this image online of basically a huge amount of their customers. Their largest customer being Samsung, a lot of Samsung customers themselves being their customers as well. Also a decent amount for Sony and Foxconn. So I thought that was pretty nice. A little corporate timeline. I'm not really so interested in that part of it, but the things that I found really useful for making my valuation was their information they had here as far as their market share in the last year, quarter by quarter, across the large panel section of their business and the other three sections, which I kind of bundle all three of these in together as the small panels. It's like large panel and small panel is for these ones as well. You can kind of see the general divergence, the higher market shares they have for the smaller panel things that they have, as well as automotive is a little bit more of a growth avenue for them relative to large panels. Like TVs is not growing as much as the electronics in automotive. That just makes perfect sense. And then I also acquired a bunch of information from some research firms, which you can kind of just do some Googling on large panel market growth and small panel market growth. You kind of find the figures that I did, but I did build a pretty simple revenue model for the company right here. I kept it really simple because, like I said, I'm not super familiar with the technology, so I'm kind of trying to think about it on a basic high level. But the market share they had for the large panel that they had in their presentation set at 9.4% in the most recent quarter, and then for on average of the small panel sections of the business, it was an average of 26%. I just kind of used the basic average for that. And then based off the market research generally that I found, there was 8.4 billion revenues expected for the large panel industry in 2027, and for the small panel, it's 9.5 billion. How much analyst coverage does the stock have? Absolutely none. Absolutely none. Right here. So that's well, either positive or negative, depending on your opinion of that one. It means there's nothing to necessarily guide our assumptions based off of for like the next year or two. But it also means that there's not going to be lots of opportunities in stocks that are not covered too. So it's a double-edged sword, stock coverage. But yeah, absolutely no stock coverage for this one. We're going in blind on this one, essentially. Anyway, so like I said, based off the market research I was kind of finding, I can see revenues for large panel industry of 8.4 billion in North America, and then small panel, it's more of an international global industry, so we go with 9.5 billion, and then I'm assuming that the market share can go from 9.4 to possibly keeping it around 10% in the best case scenario, and then down to 3% in the worst case scenario. The reason why I did that for the large panel is that if you look at their presentation, I'll back up to that part of it, you can see that they're actually declining in market share in the large panel, which makes sense because it's the more mature part of the business. So there's a lot more to lose in that section of the business. So I'm basically assuming that they basically just hold ground in the best case scenario and lose a lot of ground in the worst case scenario. Either way, that implies 845 million in the best case scenario and 254 or so million in the worst case scenario. And then small panel, they have 26%, and then that section is a much higher growth potential, and it's also much less mature. So I'm assuming that they could grow it up to 35% in the best case scenario, but also possibly get it cut in half down to 15% in the worst case scenario. Do we listen to earnings calls of all of your holdings? Of all my holdings? Absolutely. I don't necessarily listen to earnings calls for all valuations that I do. For example, I haven't listened to an earnings call for this company yet. Because I often kind of like to see what the numbers look like in some ways a little bit first before I necessarily devote too much time to that type of thing, if that makes sense. And based off of the valuation I'm seeing today, I don't know. I'm not necessarily interested, but we'll get into that. And because you might say, well, what if your assumptions about it are wrong? Well, I'll explain why that doesn't necessarily affect it for this one, because there isn't necessarily a wide range of options for that. But for my holdings, absolutely. For my holdings, I mean, if I own the stock, I probably have listened to like a couple years worth of all of their calls and stuff, at least the last year. But I might go another year back as well, depending on what's going on with that. And then as well, I try to also catch all of their presentations as well. If they do like a conference or something, some technology conference or something, I try to catch those as well. So yeah, always try to listen to all those calls, but I don't necessarily do that before these streams, just so that that part's clear. For this company, I didn't bother, because I don't know. I might start like if I get partway through the numbers, like 5 years through the numbers, and it's looking like even somewhat interesting, then maybe I might listen to it ahead of the time. Sometimes I do, sometimes I don't. But in this particular case, I didn't. So anyway, continuing on. The market share assumptions, like I said, for the small panel groupings, I see anywhere from 35% to 15%, and that gets implied revenues of 3.3 billion in the best case scenario to 1.4 billion in the worst case scenario. And so add the two sections together, I get 4.1 billion in the best case and 1.6 billion in the worst case. So those are my revenue assumptions for 2027, essentially. I've put them kind of roughly in here with the percentages required to kind of get roughly to those lines for my best and worst case scenarios. Now, I did use the average of the last 3 years of my revenue assumptions as my base here because I am assuming pretty pessimistic economic situations for the current year, generally across the board for most of my evaluations. So I am essentially implying that they might have an 18 to 19% drop in revenues this year. And then it grows up to those relatively high revenues that we just projected 5 years out after that. That's where these numbers actually come from. It's projecting from that base down up to there. So having a drop in revenues and then a big growth in revenues thereafter, which does essentially imply about a 12.5% growth in revenues over the entire time frame from this year. So yeah, and then, like I said, you can see here they had 74% growth in revenues this last year, which was the most of the revenue growth they had for the whole 10-year period. So I think assuming they lose 20% of that this year might be generous. I don't know. I mean, like I said, I'm assuming that because I think that we're going to have a pretty significant global slowdown in economic activity, and they have a really strong position in the market, but either way, they're going to be hit by that. So that's my assumptions for revenue. It's worth noting for the probability distribution, I am putting a lot of the weight into the middle. I'm trying not to like deviate too much to these more extreme outcomes per se, because like I said, I feel pretty uncertain about like the technology in the space, and it's a company in a foreign company. No coverage, all of the uncertainty kind of makes me kind of narrow it more into the middle of my projections. But either way, so moving down to the net margin assumptions. Now I currently have it as 5 to 40 in here, which gives me to an expected of 22. I might actually trim that back a little bit because, like I was saying, like this is the tricky part, and either way, the valuation's pretty rough. But I do kind of want to make it sub 20% because as we were talking about in the last 5 years, even if we just include that really rosy year of 30%, that gets us an average of about 10% of a margin. So even if you assume that they managed to keep like half of the distance between the most recent margin and the margin that they've had over the last 5 years on average, that would give them kind of around a 20%. But again, that's probably pretty rosy, so maybe down to 18%. I could maybe leave this at about 15%. That would pull the expected down to 17, 19%. Even so, it's like it's hard to be sure whether or not that's reasonable to assume, considering like if we say even just before the really high margin year, if we just look at those 5 years, completely discounting that year, that brings it to an average of 5 to 6%. So it's like if we assumed they had an average of 5 to 6%, that would absolutely like destroy the value. And valuations can be really off, but at some point or another, if your valuation is really, really far off from the market, you might ask yourself what you're saying is wrong. You might say, maybe the market has something else going on with that. Yeah, go low on the market, just not sure how much of a moat they have, if any. Yeah, I mean, that's true, but I feel like this 5 to 30 band is a pretty decent midpoint as far as that goes. Either way, the valuation's pretty bad. It's not like I'm buying it pretty much no matter what it looks like. No, I was playing around with the numbers, trying to see, it's like, what do I have to do to actually make this valuation work? Like that's like something that you can do when you have a spreadsheet like this with all the tools. You can kind of say like, well, what's the market assuming that makes this work? And honestly, it's pretty hard to make this valuation work. Yo, what's up, man? Welcome to the stream. If you're watching and you're enjoying this point, we would really appreciate extra likes. So it's like, I don't know, we pop the sales capital ratio upper bound up to 2. We put the margin bound up to 50, which brings the expected to 27. Let's increase the revenue growth upper bound to 50%. That brings the expected to 20. Look at that, and we still have it overvalued. Like, you see what I'm saying? Like, it's pretty crazy. Maybe if we increase the debt, that helps the scenario. It doesn't really help the scenario. Yeah, it seems basically impossible to actually make this valuation make sense. I'm not entirely sure like what the market is thinking here, and maybe that has to do with the fact that there's no coverage. As we were saying before, it's like if there's no coverage, then often things can get completely out of whack. Now, I was talking about how that basically makes opportunities, but it can go the opposite direction too. They have been diluting, but not by a lot. You can see right here, I have the share count for the last 10 years. 10 years ago, they had 339 million shares. And in the most recent 10K, they had 348 million. So, I mean, yeah, they diluted about 9 million shares over 300, you know, that's nothing. Like, it's like 0.5% per year. So it's not really dilution. I wouldn't really say that that's the problem. Like I said, I'm not sure what the issue is. It might have to do with the ADS. Like they do have, it's 2 shares in the home country per ADS for the exchange, and I have that set into my spreadsheet right here. But it's possible that the market is like flipping that around or something, because, like, I don't know, if you flip that around, it actually makes the valuation go the opposite direction. Or if you maybe assume that they don't even realize that there is 2 shares, then that kind of maybe makes the valuation get a little bit closer, especially if you gave them better margins as well. But I don't know, the market's not usually that dumb. And also, it doesn't really fully make sense, because if I have the way that I think it's supposed to be, where it's 0.5 ADS per ordinary share, that gets an implied market cap in USD of 1.6, 1.7 billion, which is basically what they have listed here on Yahoo. So generally speaking, that would imply that, you know, I've got the ADS ratio the right direction, you know. So I don't know. You can kind of look at the stock itself over the last 5 years, and you can see that it's been all over the place. So I don't know. Maybe it's definitely been all over the place. And even just in the last 10 years, see, like back in 2020, it was $2.30, or in 2019. Before 2020, it was essentially fair value. It was essentially fair value then. So you could argue that this is all just overly bubbly market, perhaps, even though it does seem like it's a pretty extreme level of overvalued. But either way, yeah, I think I'm going to leave the margins as I had it here. Like I said, this like 17.9%, it's 5% to 30%. That's a pretty wide band. The revenue assumptions, like I said, it's about 12.5% per year that I'm assuming over the entire time frame. The sales capital ratio assumptions that I have for them is 0.75 to 1.25, expected 1.3, versus the about 1 or so that they've had, 1.37 in the most recent year. So I'm actually giving them a little bit of a benefit of the doubt there. How is the liquidity? How much average traded volume per day? Probably pretty low, since they're foreign. That's going to make a decent amount of ETFs basically say no to them immediately. Let's see, average volume 2.7, and then like in the most recent day 2.3. You can take a look at, I have over here the volumes. What's the whole volume? We have the stock data in the spreadsheet since 2006. On average, it was 2.3. Yeah, so I mean, 2.3 million shares has been their average for the last 15 years, and their average in the last little bit is like 2.7 million, and then currently about 2.3. Yeah, probably pretty decent spread. So it could be that a decent amount of holders know it's overvalued, but they don't want to sell because of low liquidity. That could be part of it. That could definitely be part of it. But yeah, so I don't know. This is what I find on here. This is what I was, like I said, I kind of wanted to talk about potential mistakes. Maybe I'm missing something screwing here, because whenever it's more than 50% off, you kind of have to ask yourself, like, am I missing something? You know, it's like maybe the stock really is just that overvalued. But you also have to say, well, hey, maybe I'm just screwing something up. But even like I said, even if I pump up all the numbers into like the most rosy scenario possible, it still doesn't really like to get there. I mean, it could also just have to do with the fact that we're giving it such a huge beta as well. That's worth noting. We are giving it a really high beta because of its industry. If we readjust that, well, actually, that doesn't actually shift it all that much. But some stocks it does shift it a lot, and other stocks it doesn't. It kind of depends on the difference between the present and the future levels of the value. So anyway, I think that's going to be about it for this one. I should adjust the probability of default, which there basically is no real default probability of default because they don't really have much debt levels. The beta, well, the market beta is 2.01. So like if you're actually like computing beta according to the usual method, it's 2.01. But the beta that I'm using for them is 2.24 because I have an unlevered beta for their industry of 2.03. And then I'm adjusting that for their debt levels to get them to 2.24. So I use a little bit of a different method when I use beta than other people. I don't use the company's beta. I use an average of the industry's beta because I think averaging out many betas is better than one beta because individual betas have a lot of statistical noise in them. So that's just a method I use. But either way, you can see they're not that far from each other. 2.24 or 2.01. Either way, it's a pretty huge beta. So that gets them to a cost of equity of 16.8%. So, you know, that's part of the trick here is that we are also assuming 16.8% discount rate. But either way, that still gets us to a pretty low expected return no matter how you split it. Like I said, it probably has to do with the fact that it's not covered by analysts. It's a foreign company to begin with, ADS structure. It's also got low liquidity, as we were just talking about. It's got its reasons, and also it was, as we also said, it was literally fair value only 2 to 3 years ago. So it's fair value according to this valuation, to be fair. Could you please explain what beta is? I will as soon as I finish, because that might take a minute. So give me a second on that and I'll get there. So let's finish up with this. Ticker HIMX, Himax Technologies. US Treasury 10-year is selling for 2.913% or so. I'm not familiar with what that means. Like I said, I'll get you. It's a complicated topic. Equity risk premium for mature markets is 5.36%. By the way I calculate, I come up to a discount rate for the company of 16.8%. The dividend that they currently have planned in the near future is 13.03%. As I said, that's a special dividend in the near future, and they don't keep a consistent dividend, so I wouldn't expect that to stay that high in the near future. But I don't think it's a mistake that it's pretty high and they have really high discount rate. Usually those things kind of correlate with each other in certain ways. 5 years ago, they had sales of $803 million, and the most recent year is 1.5 billion or so. That gives them a sales growth of 14% per year for the last 5 years or so. Sales of capital for the last 9 years on average, we actually use a longer term average for that, was 0.99 versus the sales to capital ratio for their industry in the most recent year of 1.2 or so. They have returns on invested capital for the last 5 years on average of 12% and debt to equity ratio of about 12%. The default risk, about 1%, no major amount in the most recent year period. The profit margin in the most recent year is 30%, as we discussed, is probably more than we can expect for the future, but I did have it based off of the most recent year and allowing it to kind of guide down into our future expectations. For their industry, it was 20 to 21%, so they did have relatively high profit margins relative to their industrial expectations, while their sales capital ratio was a little bit lower than the industrial expectations. They did have profit in the most recent year of $474 million, and they currently sell for $9.59. So for the probability distribution, we have it pretty heavily weighed into the third model, partially because I feel pretty uncertain about the less optimistic and more optimistic models. So I'm kind of weighing it more into the middle. Like relative strength, kind of, it's relative risk. It's basically relative risk, but I'll like I said, I'll get into that in a minute. The sales expectations that we come out of our revenue model, we have anywhere from 1.6, 1.7 billion in the worst case scenario to possibly 4.1 billion in the best case scenario. That gets us an expectation of about 2.7, 2.8 billion in the 5-year forward period, which is a sales growth assumption of about 12.5%. But really, we have a range of basically around 1.5% to possibly 21 to 22% per year, again, for the next 5 years. Sales to capital ratio, we have an expected basis of 1.34. So we are actually being relatively optimistic on assuming that they're going to have a sales to capital ratio more reflective of the most recent year than the longer term average, which for sales to capital ratio is a more reasonable thing to assume than margins, but I digress. And then for the returns on invested capital, we're also rosily assuming that it's going to jump up to 24%, though again, that's actually a decline from the most recent year period. So it's really just moderating into the most recent time frame. And then debt to equity assumptions, we are actually assuming that they will take on more debt. They have basically no major amounts of long-term debt. It's basically all short-term debt that they roll over, which does put them in a position where if they need to expand their business or pay expenses, they are more likely to take on more debt. So that's where that assumption comes from. But either way, because of the fact that they have already really low debt to begin with, we have pretty much no default risk assumptions based off of those increases in the risk. The profit margins, I have a range of anywhere from 5% to 30%. Again, this is probably the part of the valuation I feel most uncertain about because of the completely different dynamics between the last couple of years and the longer term average they have. And it's hard to tell how much of what happened in the last few years actually gives them a more dynamic position in their industry moving forward. So anyway, we have an expectation of about 17 to 18% for the profit margins, which gets us a profit distribution of anywhere from $83 million to possibly $1.2 billion in profit. On an expected basis, we see about $500 or $500 million. So we do have a present value expected price of $2.93 per share, which is 70% lower than the current share price. Like I said, pretty devastating. We have 5-year forward value targets unadjusted for the dividends that they would pay out during the period of anywhere from $1.94 to possibly $16.80. So you can see in some of these better case scenarios, there is some return potential still to be had here, even though it would still be overvalued in the present value sense. But you could still perhaps get at least some returns per year in some of these better case scenarios. But either way, our 5-year forward expected value is $6.36, which gets an implied -7 to 8% per year for the next 5 years. So yeah, pretty devastatingly bad as far as return potential go. But as we said, there's probably a lot of odd specific reasons for how it got to be this valuation. And it could have to do with those liquidity things we were talking about, or the lack of coverage, or just the overall bubbliness of the industry in the most recent year period. So yeah, a total mess. But hey, not every valuation is something to buy. If you're doing DCFs and you find that 50% of the companies that you are valuing are a good buy, you're probably doing it wrong, in my opinion. Like honestly, just this is kind of like a general rule of thumb. It's not necessarily something that means something, but honestly, like half the valuations you do should probably be relatively fair value. And maybe about a quarter of them are undervalued and maybe a quarter of them are significantly overvalued. But, this is just a really large amount, but it is what it is. Sometimes you're going to find those. So anyway, I see that you guys were kind of continuing that beta conversation there in the chat. I was kind of reading somewhat while I was talking a little bit. Let me kind of read what GT's overall assessment was, and I'll see if I want to differ in his explanation. Beta is a measure of how stock moves up with the market, basically volatility. With a stock with a beta of 1, for example, means that for every dollar the market goes up, the stock goes up $1. A stock with a beta of 2, some volatility, Nasdaq stocks, for example, means that for every dollar market goes up, the stock moves $2. I see, thank you. Yeah. Basically accurate, and as he said, very layman's explanation, because there definitely is a lot more to it, but that is essentially the concept. It's worth understanding like what people use it for in finance, which is the discount rate concept that I was using. When we're using a discount rate, we're basically saying that if you're going to buy a stock at fair value, if you buy a stock at something that's fair value, that doesn't mean that there's going to be zero returns in the stock. It means that if you buy it today, whatever return you're going to get moving forward is a fair return. And so you have a percentage that you decide is a fair return. Now, maybe somebody might say 10%. 10% is my fair return. Now, what you're comparing, what you choose to say is a fair return has to compare to other assets. And so in the model that this is talking about, as he just referenced it, the CAPM model, basically the idea is that the S&P 500 or another major index would be the alternative that you have to investing in an individual stock. It basically says that if you're not going to buy, say, Apple stock, then you're going to go invest in the market. And so if the market is your opportunity cost, that basically means that whatever the market is likely to earn as a return should be your fair return, assuming that you are going to deviate from that to buy Apple. But it's not as simple as that, because you might say, well, what if Apple is more or less risky than the market? And so beta is a way of essentially trying to assign a more or less risk to a company based off of the volatility of the stock. Now, I kind of also referenced when I was saying, it's like I don't use individual betas, I use an average beta across industries. And the reason why I do that is because I don't think that volatility itself is actually a very accurate measure of risk. Volatility is not risk at all, in my opinion. I just think that volatility is indicative of risk. It can point out that risk has already been seen by other people. So I think that if you average many companies together, you get rid of a lot of that bad statistical noise, because for sometimes companies have low betas when they're actually very risky. And sometimes companies have high betas when they're actually very low risk. And so it can be very distorted, but it's all historical data, as you said. Yeah. And that's exactly the problem, is that it's historical data. And so the past doesn't necessarily reflect the future. So the reason why I use an average beta, for example, if I'm looking at a mining company, I don't take that stock's beta, because it's just gonna tell me how that mining company moved against the market. But if I take the average of all mining companies, then instead I'm actually getting an idea of what the typical volatility of that entire sector is like versus the market, which is going to average out some of the upward and downward errors in the data set, if that makes sense. Could turn out to be completely irrelevant, no? To a certain extent, I think it's more useful than using a single beta. But all betas are questionable, and there's lots of debate back and forth in investing circles about betas. And typically value investors are not very into the CAPM model because they don't like the idea of using volatility as risk. But this is where, like I said, I don't like to think about fair value as my only measure for investing. I focus much more on expected return, this Cogger number that I pulled up. Like, I already clicked away the valuation, but let's just pull up on the Fidelity one I have, I guess, or whatever. But when I have this summary over here, and it says this isn't the expected return, when I say that I'm expecting to get a certain amount per year, that's the part that I actually focus on more. You can use hurdle rates too. They're the same thing, effectively speaking. This is the thing, is like a lot of people don't like beta, and so instead they choose to ignore it, and they just say, oh, well, I'm just going to use a hurdle rate. And it's like, well, you're kind of doing the same thing. You're just not talking about it, Either way, if you say I'm going to use 10% as my hurdle rate, and I'm always going to use 10% for all companies, well, then you're basically just saying that you think all companies are equally risky. And if you think that's true, then I don't know. That seems like a very strange way of investing if you think that all companies are equally risky. So I don't know. In my opinion, you have to come up with some sort of way for adjusting the different types of risk, unless you're going to make it. I mean, there's multiple ways to do this. There's multiple ways to do this, because, like, for example, what Warren Buffett does is he doesn't use betas, but he also doesn't even use a full hurdle rate. Warren Buffett uses just the Treasury as his discount rate, and I'm not even sure if he uses the 10-year. I think he might actually use just the 3-month Treasury as his discount rate. But what he does is that he lowers the cash flows down to such a small level that he considers them riskless. And so he's basically taken risk entirely out of the cash flow equation, which is why he doesn't need to think about risk in the discount part of the equation. So there are multiple ways to kind of go about this, but one way or another, you have to adjust for risk. There's somewhere in the equation you have to do some sort of adjustment for risk. You may not want to use volatility to do it, but you kind of have to. Or you're implicitly saying that all stocks have the same level of risk. Yeah, don't need more beta. Yeah. Also depends if you're trying to determine the future value of the company or the price you want to pay to achieve your hurdle rate. Yeah, see, that's sort of what I was saying here, where I focus on the expected return. So like over here on this valuation right here, I have the present value 52.59, which is based off of using the discount rate of 10%. But I've also essentially taken this price and then multiplied it by a 10% return 5 times over to get to this price, 85.40. And so that's what I think the value is going to be 5 years out. Now, again, you would have to subtract out the dividends because the share price is going to be whatever this is minus the dividends they pay during that period. So it's going to be lower than that. It might be like $75 a share or something. But the future value is important. And then that's why what I do is I take the future value and then I divide it by the current share price. And then I take that ratio and compound it back by 5 years to find out what the expected return for the 5 years is. So essentially, this return, the 14.97%, takes the discount rate I use, but it also adds in essentially the 23 to 24% that I say it's undervalued. And it's essentially just adding that part in, and it gets to the 14.97%. And this is the thing I think is much more important to focus on. It's like, I'll buy stocks that aren't really that undervalued in a present value sense sometimes, just because the future return potential is really good. Here, I actually have a really good example. Here's a really good example. Barrick Gold Corp. This is one of my personal holdings. It's a gold mining company. And you'll notice the discount rate that I have for the company is 21%. 21%. And the reason why is because precious metal miners have very high volatility. So the sector gives me a really high beta, and that gives me a really high discount rate, which gives me a present value for the company of $11.90, 43% lower than the current share price. Although it's actually a little bit higher than that because there's like a future box down here, but whatever, we can just focus on this part right now. But either way, I have the future value as being 31.25 because it's assuming that we're going to get 21% per year for the next 5 years. And so, yeah, it's overvalued today in a certain sense, but that only assumes that you want to use 21%. For example, I've used other boxes down here instead. If we, for example, instead switched it to 14% for the next few years or so, it makes the present value switch to 1761, but the same future value. See, it's the same future value, but it can kind of change the way you think about the present value if you just think about what return matters to you in the next 5 years versus every year thereafter. So basically, it's like what this implies is that if you bought it at 1761, you could earn 14% each year for the next 5 years, and then earn 21% per year every year thereafter. Which, it's like, well, it's a little bit lower for the next 5 years, but it's still good returns. Yeah, understanding the present value, future value equation can kind of change the way you think about it. It's like present value, I don't necessarily care about present value. I care about the returns, the future potential returns, which usually means the stock's undervalued, but not necessarily always. Now, to get to that last question, Nukit, is inflation. Is that in the equation? Yes, it absolutely is in the equation because it's already here. It's in the 10-year treasury. The 10-year treasury is at the bedrock of the discount rate to begin with. That's kind of how this works. Is you start with a 10-year treasury because that's considered the riskless asset. And then you add on a premium to that for the market, which is what this equity risk is right here, 5.36%. You add those two together, you get 8.27%. And that's my current expected return for the S&P 500. So I believe that the S&P 500 for the next 5 years is likely to earn maybe 8.2%, or that's what I think the market is pricing. I don't actually think it's going to earn that because I think the market's likely to go down way, way, way more than that. This is what I think the market is pricing. If the market was fair value today, it would be earning 8.27% per year. Here, hold on, just one second. I gotta let my cat out. Sorry. But anyway, so like I said, 8.27% is what the market, if it was fair valued, would be earning for the next 5 years. But then I have a discount rate of 10.192%. So somehow I managed to get an extra 1.7% or so added onto there. And that's the effect of the beta. The actual beta that I'm using for Fidelity, again, it's an industry-based beta, and it's adjusted for the debt levels of the company, but I'm using 1.36 as the beta for the company. And then the market beta, if you actually just judge it based off the volatility, is 1.41. So I actually think that they could deserve a slightly lower beta in this case than the market says, while, for example, for HIMX, I actually had a slightly higher beta than the market did. Yeah. All right, so yeah, like I said, a little bit of a long-winded concept. You can honestly talk about this topic for a very, very long time because there's just so many more details even to get into it. It involves like a lot of statistical stuff. And as we said before, there is a lot of debate when it comes to the topic too. People have all sorts of opinions across the board. And there isn't necessarily one right answer. There's lots of ways to kind of go about this situation. But yeah, always happy to kind of talk about those things. So anyway, I do think that's pretty much going to be it for today. As we said, not every valuation looks like a great buy, and HIMX, we're definitely going to have to be passing on that one. As I said at the start of the stream, I'm going to probably be doing WSM next, Williams Sonoma. I've already kind of begun doing some of the legwork on that one. So people can expect that sometime in the near future. If you haven't already liked the stream, but it would be really appreciated if you would. It helps us attract new viewers to the channel. I know my valuations have been a little bit slow in the last week or so. Like I said, I started doing some summer work, and that's been taking up a lot of my time and energy. I'm hoping to get back a little bit more into a regular system of it, but it is probably going to be one valuation per week for at least the summer. So that just kind of is the way it is. But like I said, WSM is looking like the one we're going to be doing next. And if people haven't joined the Discord server, as I've talked about, that is a great place for people to join and share their thoughts and converse with other people in the community. So I will catch you all again next time.